Okay, so now we are starting Indas 33, that is earning per share. Earnings per share. If you can see the index, very small, very few concepts are there. It seems very few concepts are there, but not like that. Each and every concept will take time. Good morning, Binu. So we are starting Indas 33. Earnings per share. Acha, guys, please remind me that after today's session, I want to discuss with you the schedule of the batch, right? The schedule. I have prepared the schedule in rough, and actually I would like to discuss with you on Zoom, and if possible we'll have a Zoom meeting, okay? So Indas 33 earnings per share. Earnings per share. Indas 33 earnings per share. Now, before starting this particular session, earnings per share, I wanted to remind you about Schedule 3 format. Schedule 3 format of your profit and loss account. Statement of profit and loss. If you can remember that under statement of profit and loss, this Schedule 3 requires to disclose earnings per share. See, on the face of the P&L. If you can see last three rows, like earnings per equity share from continuing operation, earnings per equity share for discontinued operations, and earnings per equity share for the total operation, matlab continuing and discontinued operations both. Which requires this disclosure? Which pronouncement requires this disclosure? Specifically, Schedule 3 requires. Schedule 3 requires to disclose the EPS on the face of statement of profit and loss. So basically, it is the Schedule 3 who actually requires you to disclose the EPS. Guys, understood or not? Now, but how to calculate the EPS? That is to be understood under Indas 33. So the requirement of disclosing EPS is basically came from Schedule 3. But how to calculate EPS and DEPS, basically earning per share, basic earning per share, diluted earning per share, how to calculate the earning per share? Schedule 3 and the companies that specifically says that follow Indas 33. So we need to follow Indas 33 to calculate earnings per share. And the disclosure is required by Schedule 3. Okay? Okay, correct. If you can see under the disclosure, there are two kind of EPS, basic, diluted. So EPS are of two types, basic earning per share, diluted earning per share. Okay. Indas 33 earnings per share. So overall, for the basic understanding purpose, for the simplicity, in today's session, I am not going to talk about diluted earning per share. Diluted earning per share will be discussed in the further classes. Okay. So today we are going to discuss about basic earning per share and some important presentation, how to present the earnings per share. Okay. So keep your copies ready with a new page. Your pen, your calculator. Earnings per share. The beautiful thing about learning is that no one can take it away from you, obviously. Learning is the only thing which actually your asset, and this asset can never be taken from you. So yes, knowledge is one of the most important thing. Guys, first of all, let us understand about the presentation part. Let us understand about the presentation part, the presentation of EPS. Let us understand about the presentation part, the presentation of EPS. The presentation of EPS. This Ind AS shall apply to the companies that have issued ordinary shares. That have issued ordinary. Guys, what do you mean by ordinary shares? Ordinary shares means equity shares. If you have issued equity capital, that means this is the ordinary share. But if you have issued preference share, if you have issued debenture, this is not an ordinary share. Debenture is never an ordinary share. But if you have outstanding preference shares, outstanding employee stock option plans, these are not ordinary. Ind AS shall apply to the companies that have issued ordinary shares to which Ind AS notified under the Companies Act apply. So any company which applies Ind AS has to apply Ind AS 33 also. Ind AS 33 will be applicable when the company has outstanding equity shares. Obviously, every company must have the outstanding shares. Okay. When an entity presents both consolidated financial statements and separate financial statements. See, we already discussed about these financial statements. Like if an entity prepares both the type of financial statements, separate as well as consolidated. Separate, why? Because I am preparing the financial statements for my own business. Why consolidate? As a group, because I have some subsidiaries. So if the entity is preparing consolidated and as well as separate financial statements prepared in accordance with 110 and 27 respectively, the disclosure required by this standard shall be presented both in the CFS and SFS. So if you are preparing SFS as well as CFS, you have to disclose the EPS in both SFS and CFS. You can't do like that I am preparing CFS now, so I have already disclosed the EPS in CFS, so why should I disclose the EPS in SFS? No, not like that. Because EPS under CFS may be different from EPS under SFS. Because CFS is for entire group. So the EPS to be disclosed under CFS shall be of entire group. But as far as SFS is concerned, EPS is for the particular company only. Okay. The above mentioned provisions are given in the following table. Type of financial statements. If you have consolidated financial statements, you will disclose the consolidated EPS. Yes. For consolidated financial statement, you have to calculate consolidated EPS. For separate financial statements, you have to disclose separate EPS. Now, what do you mean by consolidated EPS? What do you mean by separate EPS? See, if I am preparing separate financial statements, I will prepare a profit and loss statement also. Whatever the profit I am gathering, I am generating, that profit is for my shareholders. That profit is for my shareholders. Okay, understood. The profit is for my shareholders from my business, from our business. But suppose if we have subsidiary also, and now we are preparing consolidated financial statements considering subsidiaries business also. Now, in the profit and loss from CFS, in the profit and loss of CFS, there will be two businesses, the business of holding company, the business of subsidiary. So the entire profit will have two parts, the profit from holding business, the profit from subsidiary business. And if you remember, the overall profit shall be further divided into two parts, the profit attributable to non-controlling interest of subsidiary and the total profit belongs to shareholders of parent company. So basically, if you imagine, like under SFS, the profit for the shareholders is definitely different from the profit for the shareholders of parent company. So technically, under SFS and under CFS, earnings may be different. And if earnings may be different, the earning per share may be different. For CFS, it must be consolidated EPS. For SFS, it must be separate EPS. So for consolidated financial statement, just disclose consolidated EPS only. ठीक है ना? Understood or not? No need to disclose separate EPS also in your CFS. In your consolidated financial statement, no need to disclose separate EPS. Types of financial statement. Types of financial statements. In your separate financial statements, no need to disclose the consolidated EPS, but you have to disclose the separate EPS. So obviously, if you are preparing CFS, disclose consolidated EPS. If you are preparing SFS, disclose separate EPS. Simply. Guys, understood or not? EPS should be presented in the following headings. EPS for continuing operation. EPS, ये basic should not be there. Please cut the basic. Overall EPS, like it can be basic, it can be diluted also. So EPS for continuing operation, EPS for discontinuing operation, EPS for total business. And we have just saw these three headings in our statement of profit and loss account. Remember? So this is the presentation part. When you are preparing consolidated financial statements, just calculate the consolidated EPS only and disclose it. For separate financial statements, calculate the separate EPS and disclose it. EPS must be disclosed or presented in the following headings. EPS for continuing operations, EPS for discontinuing operations, EPS for total business. Okay? So this is the presentation part for the EPS. How the presentation will be done. Okay. Now from here, the calculation part starts. From here, the calculation part starts now. The calculation part starts now. From calculation part, measurement of basic earning per share. Now see, please understood. Now we are going to talk about the basic earning per share only. We are starting with basic and we'll continue further. In the further classes, we'll discuss diluted earning per share also. So measurement of basic earning per share. Now please concentrate on the basic earning per share. First of all, I would like to ask you, what is the formula for EPS? How to calculate EPS? Can you guys please tell me what is the formula of EPS? What is the formula of EPS? Tell me. What is the formula of EPS? What is the formula of EPS? How to calculate EPS? Profit after tax divided by number of equity shares. Okay. EAT, earning after tax divided by number of shares. Earning after tax divided by outstanding number of shares. Profit after tax divided by number of shares. Profit after tax. Everyone is saying profit after tax. Guys, profit after tax is not considered for EPS purpose. Okay. So the formula of EPS is profit or loss attributable to shareholders, equity shareholders. Profit or loss attributable to equity shareholders divided by weighted average outstanding equity shares during the period. Like period can be annual, period can be quarterly also. So first of all, it's not profit after tax, please. First of all, clear this point that it is not profit after tax. It is the profit or loss attributable to equity shareholders. And this profit is totally different from profit after tax, because of profit, when you earn the profit after tax, you have to pay the preference dividend also to your preference shareholders. So after when you get the profit after tax, you have to deduct the dividend declared by your company for preference shareholders. And after deducting the dividend, what you will get? You may get the profit or loss attributable to your equity shareholders. So remember one thing, we are calculating EPS only for equity shareholders, because in the first line only it was written that if the company is having outstanding ordinary shares, then only company has to disclose the EPS. So EPS is calculated when the company has equity shares, and EPS is calculated for equity shareholders. Understood? So this is the basic formula: profit or loss attributable to equity shareholders divided by weighted average outstanding equity shares during the period. Now, as far as denominator is concerned, what do you mean by weighted average? See, we'll definitely discuss it in details, but for the timing, I'll tell you in short. Weighted average, why we are doing weighted average? See, in a particular year, suppose we are calculating EPS for a particular financial year. Now, in that financial year, we were having some opening outstanding shares, say 1 lakh. During the year, we issued some, we made some public issue. We made some public issue of the same equity shares, or we made some right issue of same equity shares which were already outstanding during the year. During the year, suppose we made the bonus issue on a different date, different from right issue, different from public issue. In the same year, we announced a buyback of same ordinary shares, some of the buyback, not 100%. Buyback is not allowed to the extent of 100%. Buyback is allowed only to the extent of 25%. If you remember your IPCC days. So we announced the buyback on different date. We announced the right issue on different date. We announced the public issue on different date. All for same class of equity shares. In the meanwhile, suppose there were some convertible preference shares which got converted into equity shares in the current year only. So they also converted into ordinary equity shares. In the same year, suppose the ESOP, or employee stock option plan, ESOP has been converted into equity, like ESOP has been availed, ESOP has been exercised, and we have to issue the shares. So there are so many transactions, there may be so many transactions during the year in respect of the same class of equity share. There can be so many transactions during the year in respect of same class of equity shares. In respect of same class of equity shares. Guys, understood or not? So considering this, we can't take final total number like the closing balance of equity share. We can't do like that, because in the entire year, so many shares were issued in the mid of the year. So many shares have been bought back in the mid of the year. So each and every share may have different right or proportionate right over the earning of the company based on the issue or based on the buyback, date of buyback. See, if a particular share were outstanding for the entire 12 months, so the earning that share would be eligible for the entire year's earning. But suppose if a particular share was issued in the month of July only, that means after April, May, June, in the month of July only, then that share will be eligible for company's 9-month earning in the current year. So technically, what we need weighted average numbers considering all the transactions of equity. I hope you are getting my point. I hope you are getting my point. Guys, have you understood the thing? Guys, have you understood the thing? Manasalai, yes, good. Guys, I need a new word to learn, please. Just tell me what we call rain in Malayalam. Raining season or rain, because right now in Bhopal there is so much rain. There is a raining season. So much of rain every day. So what we call rain? We call rain as Mazha. Mazha. M-A-Z-H-A. Mazha. And in Hindi we call Maja is like enjoyment. Maja. But you call Maza. Arya, I am waiting for your voice note. Arya, I am waiting for your voice note for proper pronunciation. Maya. Okay. Mada. Acha. Okay. Okay. Mada. Okay. Maya. Okay. Maya. Am I pronouncing right? Yes, now clear. Okay. Maya. Okay. So let's start. Measurement of basic earning per share. We just discussed the formula. Profit or loss attributable to equity shareholders divided by weighted average outstanding equity shares during the period. Okay. Okay. An entity shall calculate basic earning per share for the profit or loss attributable to ordinary shareholders of the parent entity, and if presented, profit or loss from the continuing operations attributable to those entities. See, one by one we will discuss what about parent, what about continuing operation, one by one. Don't worry. First of all, let me tell you one more thing. Suppose if we are preparing consolidated profit and loss statement. Guys, see, when you prepare profit and loss statement and when you get your profits, matlab earnings, after declaration of earnings, these are the earnings after declaration of preference dividend. So we divide this earning into two parts. If we prepare the consolidated profit and loss statement, consolidated statement means the statement of the group. You remember what do you mean by group? Consolidated financial statement. So the earnings shall be subdivided into two categories. Earnings for NCI, non-controlling interest, NCI of subsidiaries. Like NCI of subsidiaries matlab the shareholders of your subsidiary company. Matlab out of how much profit, like suppose we have 500 crore of earning this year. Now out of 500 crore of earning, how much profit belongs to NCI of your subsidiary? Like shareholders of your subsidiary company, not your company shareholder, not parent company shareholder. Suppose NCI of subsidiary, the profit belong to NCI of subsidiary is, let us say 35 crores only. So the second classification would be earnings for earnings for shareholders of parent company. So basically when we deduct 35 from 500 minus 35, 465. 465 crores. 465 crore. So basically what is this? 465 crore is the earning available for shareholders of parent company. Technically we prepare the consolidated financial statement for shareholder of parent company only. So what is this now? Have you imagined this situation? Now we need, I can say that we need 465, we need the earnings as far as consolidated EPS is concerned. As far as consolidated financial statements, we need consolidated EPS, and for preparing consolidated EPS, we need this profit, the earnings attributable to the shareholders of parent company. So, entity shall calculate basic earning per share from the profit or loss attributable to ordinary equity shareholders of parent entity. Okay. The profit must be belong to the equity shareholders of parent entity only. So when you calculate the basic EPS, when you calculate the EPS under consolidated financial statements, you don't need to take the 500 crore rupees. You need to take 465 only. Because you are calculating earning per share for your group shareholders. For the shareholders of the group. And shareholders of group means shareholders of parent entity. Guys, understood or not? Tell me guys, understood or not? Manasalai? Manasalai. Okay. Understood. Clear? Okay. If presented, the profit or loss from continuing operation attributable to those equity shareholders. वो तो definitely we need to present the profit EPS from continuing, discontinuing as well as total operation. Okay. Thus, one can note two important points from the above paragraph. Company is required to calculate EPS for equity shareholders, for parent company. See, for equity shareholders, off होगा इधर. Of equity shareholders of parent company. You must note this point that we always need to calculate EPS under CFS for equity shareholders of parent company. Understood or not? So whenever we calculate the EPS, we take into account this 465 crore. 465 is from my example. That means we take earnings for shareholders of parent company. Okay. According to the appendix to the Indas 33, the purpose of calculating earning per share based on the consolidated financial statement, profit or loss attributable to parent entity refers to profit or loss of consolidated equity after adjusting for non-controlling interest. That means out of the total profit, first of all deduct profit belonging to NCI, and then whatever the profit remains, that you can take for the purpose of calculating earning per share. Okay. So profit or loss attributable to equity shareholders of parent entity divided by weighted average number of equity shares outstanding during the period. Simply. So this was the formula. Simple. Numerator as well as denominator. So there is one numerator, the amount, the denominator, that is the number. Okay. That is the number. Any doubt? Any doubt? Here I can write profit loss attributable to equity shareholders of parent company. Clear? Clear? So tell me, do you want to ask anything? Okay, okay. Now see, we are further subdividing this basic earning per share topic into two parts. Now first of all, we will understand about the numerator part. That means how to calculate, how to arrive the profit or loss attributable to equity shareholders of parent, how to arrive this figure, numerator part. So first of all, we will understand the numerator portion, then we'll cover the denominator portion also. Please let me clear you one thing, that the denominator portion is more important and is more like a bit complicated compared to numerator part. Okay. So the numerator part is somewhat easy. It is somewhat easy. Okay. The numerator part is somewhat easy. Now please wait a minute. Let me check one thing. In my regular course batch, I discussed one question, if I am not wrong. One example. Okay. We'll consider after that. Okay. Numerator is concerned. Okay. Now, first of all, one more thing. Is it possible that EPS can be negative? Is it possible that EPS can be negative? Tell me, is it possible that EPS can be negative, or EPS will always be positive? Tell me guys, what do you say? Is it possible that EPS can be negative? It can be negative, yes, because see, the formula says profit oblique loss. The earning can be negative earning also. During the year, the company may have the loss per share also. So yes, the EPS can be negative. So EPS can be negative. Guys, understood or not? Okay. Now, as far as numerator for basic earning per share is concerned, what are the important considerations? What are the important points we need to understand? First, profit loss under consolidated financial statement. Sir, why we are focusing more on CFS? You may have observed that under this topic of EPS, we are focusing more on consolidated financial statements compared to separate. See, under IFRS, CFS is mandatory for every company, or under IFRS, you have to prepare CFS always. So the standards are basically penned or basically written from the entire consolidation point of view. Because when you prepare the financial statements on consolidation basis, ultimately entire group business will be covered. So yes, we are more focusing on CFS here. So profit or loss under consolidated financial statements. Profit or loss attributable to equity shareholders of parent company. Attributable to equity shareholders of parent company. Profit or loss attributable to equity shareholders of parent company, not considering the earning of NCI. We already read that point. This is already covered. We already discussed this point, that when we calculate the earning per share, the numerator belongs to equity shareholders of parent company only, not NCI. Okay. What about preference dividend? Preference dividend shall be deducted from PAT, profit after tax. In case there are cumulative preference shares, then dividend shall be deducted whether declared or not. And in case non-cumulative preference shares, dividend shall be deducted only when it is declared. Always assume cumulative if specified in the question. Now please see this. We are talking about preference dividend. What to do with the preference dividend? Preference dividend on cumulative shares, on non-cumulative shares, on cumulative shares, on non-cumulative shares. Okay. So as far as cumulative shares is concerned, preference dividend on cumulative preference shares is concerned, always deduct dividend from PAT. Declared or not. Declared or not. Whether it is declared or not, you have to deduct it always because it is on cumulative preferential. It is accrued actually. Cumulative, that means the dividend is accrued. But on non-cumulative preference shares, deduct the dividend from PAT only when it is declared. When it is declared. When it is declared. When it is declared. Okay. So if you have cumulative preference shares, always deduct the amount of dividend. If you have non-cumulative preference shares, deduct only when it is declared. Now suppose if in the question it is not clear whether the preference shares are cumulative or non-cumulative, always assume that these are cumulative preference shares. Always assume cumulative if not specified in the question. Okay. Always assume that the dividend is, preference shares are cumulative. So please write this. Correct? Okay. Okay, correct. Numerator for basic earning per share, right? So preference dividend. Now this third point is important. Premium paid or the settlement premium on the redemption, like early redemption, or conversion on the redemption of preference shares and return off from the security premium account or from other reserve shall, it is not saying may, shall also be deducted from the profit for the purpose of EPS. Now what is this? When any company redeemed the preference shares, when any company redeemed any preference shares at a premium, and suppose the premium expense, what is the premium? Premium is the extra amount we are paying to our shareholders in case of redemption. Suppose a preference share is having a face value of 100 rupees, we announce a redemption at 110. So what is this 10 rupee per share? 10 rupees per share is the premium amount, which is our actually expense. Now some companies may charge premium in their profit and loss account. some companies may charge or may write off premium from their security premium account, not charging, not debiting to the profit and loss separately. Some companies may write off the premium directly from retained earnings, opening retained earnings. Some companies may write off the premium from other reserves. So for every company there may be a different treatments. Indas 33 says that for calculation, for the purpose of calculating numerator, that is the profit, that is the earning attributable to shareholders, always deduct the amount of premium from the earning. Always deduct the amount of premium from the earning, whether or not you have debited such premium in your profit and loss account. Even if not debited in the profit and loss account, even the premium amount is not debited in the profit and loss account, it was directly written off from the security premium balance. Then also, for the purpose of calculating EPS only, you have to deduct deduct the premium amount from the earnings. Then only you can calculate the earning per share, even though you have not debited that in the P&L. We are not saying that you should debit the premium in your profit and loss account only. No. We are just saying that our requirement is to calculate EPS, and for calculating EPS, the earning should be after tax, after preference dividend, after this premium expense. Second point is clear or not? So the premium paid or the settlement premium on the early redemption or the conversion of redemption of preference shares and written off from security premium account or from other reserve, that means written off somewhere else, not in P&L, then shall also be deducted from the profit for the purpose of EPS. Please tell me, this is the important point. The second point is very important. Please tell me, have you understood the things? Have you understood the things? Okay, the fourth one. Acha guys, currently we are at numerator. What we are understanding right now? How to calculate the numerator portion for the purpose of EPS. Okay. The numerator portion is the profit. The profit must be after tax, after preference dividend, after writing off premium if any. Okay. Okay. Now it says any income or expense which is otherwise required to be transferred to P&L account but not actually recognized in profit and loss account and transferred to other reserve or written off from security premium like preliminary expense shall also be considered. Please guys explain. Explain this point to me. It is a very simple point. Explain this, please. Explain this. Okay. Any income or expense which is otherwise required to be transferred to P&L but not actually recognized in P&L and transferred to other reserves or written off from security premium shall also be considered. Like suppose if the company has made a wrong treatment, like any income which was required to be transferred to P&L but the company has directly charged it to capital reserve, or there is a preliminary expenses. Technically as per Indas 38, preliminary expenses should be entirely written off to the profit and loss. But suppose preliminary expenses, the company has made a wrong treatment and preliminary expenses were directly or were shown under the other reserves and not charged to P&L. It was charged directly to the reserves. So you have to deduct such amount of expense. You have to increase the amount. You have to add the amount of income if such income or expense was not charged to P&L. It was required to be transferred to P&L but not actually done this. Okay. Okay, the last point but not the least. If the preference shares are classified as financial liability under the AMC amortized cost method under 109. See, we haven't discussed 109 till now, but I'll discuss a bit portion of this to let you understand. Okay, so if preference shares are classified as financial liability under amortized cost method of Ind AS 109. Now forget about this amortized cost. Okay. Then for the purpose of calculating earnings attributable to equity shareholders, dividend or interest shall be deducted as per the effective rate of interest. Now what is this? Guys, tell me one thing. If you have outstanding redeemable preference share capital 3 crore rupees, where you will show it? This is a redeemable preference share capital 3 crore. Where you will show it? I am giving you two options, either under share capital or under non-current liability. Suppose it is redeemable after 5 years. So where you will show it? Either under share capital or under non-current liability. Tell me. Where you will show it? Where you will show it? Tell me. If you have outstanding redeemable preference share capital of rupees 3 crore, where you will present this amount? Either under share capital or under non-current liability. Guys, it will be your non-current liability because it is not your, see, it is as good as a liability. It is a financial liability because you are obliged to repay amount of rupees 3 crore. You are obliged to repay the amount of rupees 3 crore. See, share capital is something where you don't have any obligation. Share capital or the equity is something where you don't have any obligation to repay. But suppose if you have any particular obligation to repay in cash, that must be your financial liability, and that is defined under Ind AS 109. So Ind AS 109 says if the company is obliged to settle the instrument, this is the instrument, to settle the instrument in cash, then such instrument will be treated as financial liability, not the equity capital, and therefore it will be your financial liability. It will be your financial liability. And suppose if it is a financial liability, technically what you are actually paying on this, you are actually paying dividend on this. But since it is a financial liability under Ind AS 109, since it is a financial liability under Ind AS 109, Ind AS 109 says we have to calculate the finance cost or the borrowing cost based on effective rate of interest. Now please remember one thing, we just completed Ind AS 23. We just completed Ind AS 23 and we already discussed that issue of effective rate of interest. If you remember, one second. If you remember, see this. This was the question we actually solved in our Indas 23, and we learned to how to calculate the effective rate of interest. So basically, if you have the preferential capital and you treated such preferential capital as your financial liability, definitely Indas 109 will be applicable, and as per 109, you have to calculate the finance charges on preferential capital. Yes, finance charges. You have to calculate the finance charges or interest cost or borrowing cost on such preferential capital based on effective rate of interest. And such finance charges or borrowing cost will be debited to the profit and loss if not capitalized. If not capitalized as per Indas 23, if debited to profit and loss, then you must consider such finance charges. Like you have to deduct such finance charges also when you calculate the numerator for the purpose of EPS. Understood? Clear? So let us read once again. If preference shares are classified as financial liability, then for the purpose of calculating earnings attributable to equity shareholders, dividend interest shall be deducted as per effective rate of interest. As per effective rate of interest. You have to deduct the dividend. Acha, sir, do we need to deduct 2 times? No. You need to deduct the amount only once. Like you have paid the dividend actually by rupees 10%. But in your profit and loss, you charged finance charges or borrowing cost on the same preferential capital with the rate of 12% effective rate. So you consider 12% effective rate expense while calculating numerator. Now no need to deduct dividend once again of rupees 10%. So no need to deduct the amount twice. Okay. So if preferential capital are treated as financial liability, then we will deduct the dividend with effective interest rate method. Okay. Now the numerator part, the discussion on numerator part, the theory portion of numerator part is over. We'll discuss some questions, some small illustrations also. We'll discuss some small illustrations also. Okay. We'll discuss some small illustrations also. Okay. Now give me 5 minutes, or not 5 minutes actually, give me 2 minutes only, and you, if you want, you can just revise the entire thing. Okay. Revise it please. Okay. So numerator is fine. Let us discuss some illustrations. Let us discuss some illustrations. Okay, illustration number 1. Illustration number 1. P Limited has an earning of 15 lakh, outstanding shares of 50,000. Okay. P Limited has one subsidiary. Okay. That means we are talking about CFS. S Limited, where P has 80% investment in S Limited. That means P has acquired 80% of the equity interest of S Limited. P is the shareholder of S Limited. P will get 80% earning from the S Limited, whose earning is 5 lakh. Okay, the subsidiary earns 5 lakh rupees in the current year and subsidiary's outstanding equity capital is 20,000. Okay, calculate the basic earning per share of P for separate as well as consolidated financial statement. Now they are requiring the EPS for parent company only. For parent company only. For parent company only. Okay. So for parent company, what is the EPS? EPS is, numerator. What will be the numerator? Numerator will be earnings attributable to shareholders of parent company. So if you can see that earnings attributable to shareholders of parent company must consist of two things: the 15 lakhs which is originally earned by P Limited, 15 lakh the earning of P Limited, that means the earning of shareholders of P. 15 lakh is the earning of P Limited, that means it is attributable to the shareholders of P Limited, plus 5 lakh earned by subsidiary. 5 lakh earned by subsidiary. Since 5 lakh is earned by subsidiary and P Limited is the shareholder of subsidiary. P Limited is having 80% investment in subsidiary. So definitely out of this 5 lakh, 80% belongs to P. And if 80%, that means 4 lakh belongs to P, it must belong to the shareholders of P. So 80% of 5 lakh. Because rest 20% belongs to NCI. Rest 20% belongs to NCI. So overall 19 lakh is the earning attributable to shareholders of parent company. Shareholders of parent company. This is what we call numerator. Now, how to calculate basic earning per share? For basic earning per share under CFS, under SFS, under CFS, we need consolidated earning. So 19 lakh of P Limited. So 19 lakh divided by number of shares of P Limited, 50. That comes to 38 per share. And under SFS, we need just the separate earning of P, its own earning, not from subsidiary, excluding the subsidiary's earning, like 15 lakh. ₹30. In both the cases, we took denominator as 50,000, 50,000. Why? Because here we are calculating the earning per share of P Limited and P has outstanding 50,000 equity shares. in P Limited's balance sheet, whether consolidated, whether separate, there are 50,000 outstanding equity shares. Sir, why don't you have taken 20,000 outstanding shares of subsidiary? Beta, it is 20,000 shares issued by subsidiary. It is not issued by parent company. See, EPS is always calculated for the shareholders of parent company. So, who are the shareholders of parent? Those 50,000 shares. Those who hold the 50,000 shares. Understood? So, yes. Sir, number of shares equal always for SFS and CFS? Yes, but please do not learn this thing. Concept should be clear. Under SFS or under CFS, when you prepare the balance sheet, of parent company, whether such balance sheet is of CFS or such balance sheet is of SFS, what you need to write? You need to write the share capital issued by parent. What the concept is? The concept is the share capital issued by parent company, bete. Issued by parent company only. The share capital issued by parent company. So definitely it will always be the same. Okay. Guys, illustration number 1, any doubt? Do you want to ask anything? Do you want to ask anything? Okay. Now let's cover one more question. Illustration number 2. P Limited has earnings of 15 lakh, outstanding shares of 50,000. Okay. So technically, EPS for SFS will be 30, like 15 divided by 50. 15 lakhs divided by 50,000. P Limited has one subsidiary company, S Limited, 80% investment, whose earnings are 5 lakh. Subsidiary has total outstanding shares of 20. Okay, same. During the year, S Limited paid dividend of rupees 1,50,000 to its shareholders. During the year, S Limited paid dividend of rupees 150 to its shareholders. Tell me, who is the major shareholder of subsidiary company? Who is the single major shareholder of subsidiary company? Who is the single major shareholder of subsidiary company? It is the P Limited who is the single major shareholder of subsidiary company holding 80% shares. So if subsidiary company is paying dividend of rupees 150 to its shareholders, P is the major shareholder. So definitely P must have got the dividend. P must have got the dividend. Nah? P must have got the dividend. So out of 150, 80%, that means 120 has been received already by P. P must have received the dividend of 120, yes or no? P Limited must have received the dividend of rupees 120, yes or no? Tell me. Yes or no? Tell me. P company must have received a dividend of 120, yes or no? Yes. And if it has received 120, definitely such 120 has been credited by P Limited in its separate financial statements profit and loss. Such dividend income of 120 received by P has been recognized by P as an income under the profit and loss account of P. Under the profit and loss account of P, yes or no? Yes. So definitely this 15 lakh must contain the amount of 120 dividend income also, which is received from subsidiary company. Because P has received 1,20,000 dividend income from S and P has entered one entry. P has journalized one entry, bank account debit to dividend income, and such dividend income was charged to profit and loss account of P. So definitely the 15 lakh rupees of earning of P must consist of those 120, those 1,20,000 must consist of those 1,20,000 dividend income also. Yes or no? So here EPS for consolidation will be what? See, we already have 15 lakh of earning, and this 15 lakh of earning must consist of 120 dividend income already received from subsidiary. How much profit earned by subsidiary? 5 lakh. But out of this, subsidiary has declared the dividend of 150, which is already received by P. So for the remaining portion, I must be eligible for 80% earning. Sir, why you are deducting 150 from 5 lakh? See, 5 lakh is the earning earned by earning of subsidiary. Total earning of subsidiary. Out of this total earning of subsidiary, 150 has been distributed. And out of this 150, 120 has been received by P Limited. So technically this 150 is already inclusive of 120. Already inclusive of 120. Understood? So I am deducting here because it is already included here. I am deducting from this because it is already included here into 80%. Into 80%. Understood? Divided by number of shares, 50,000. $1,780 divided by 50,000. 35.6. 35.6. Or you can take like, suppose there is alternative solution. 15 lakh is inclusive of 120. So I reduced from here. Plus total earning of 5 lakh and I am eligible for 80%. So 15 minus 1.2 is 13.8 plus 4 lakh. So ultimately it is 17.8. One in the same thing. One in the same thing. Guys, clear? Guys, understood or not? Okay. Leave the third question, third illustration, it is based on denominator. Leave the third question illustration, it is based on denominator. We'll discuss it in the next class. Please cover this question, illustration number 4. Try this out. Yes, illustration number 4. I think they have paid the settlement premium. They have paid a settlement premium on the redemption of preference shares. Guys, clear? Shall I continue? Shall I continue to illustration number 5? Shall I continue to illustration number 5? Okay. Illustration number 5. It is not taken from any module, any ICI material, any other book. It is actually an example which is prepared by me, and we will solve it properly. Okay. Consider the following info for the purpose of calculation of basic earning per share for the year ending 31st March 19. For the year ending 31st March 19. Okay. First of all, we have earning before interest and tax, EBIT of 35 lakh. Okay. We have outstanding debentures as on 1/4/18. That is the beginning of the year. We have outstanding debentures of, it's 1 crore 20 lakh or 12 lakh. Please wait. Okay. It's correct. It's the correct figure. It's, if I'm not wrong, 1 crore 20 lakhs. 1 crore 20 lakhs. Cumulative 9%. Cumulative 9% preference shares, 8 lakhs. Dividend not declared. Doesn't matter. If they are cumulative, dividend declare or not, we have to deduct it. 10% non-cumulative preference shares issued on 1/6/18. Issued on 1/6/18. 10 lakh. Dividend declared. Dividend is declared now, we have to consider it. Out of above 9% cumulative preference shares, matlab this one. Out of above 9% cumulative preference shares, 25% redeemed in the beginning of the year. Redeemed in the beginning of the year. Redeemed in the beginning of the year at rupees 3 lakh. Extra paid is premium on redemption with respect write-off from security premium account. You will get the premium amount here. So guys, what is the 25% value? What is the 25% value of 8 lakh? It's 2 lakh. The 25% value is 2 lakh. And we redeemed at 3 lakh. So 1 lakh is the premium. And you've written off the premium from security premium account. You have to consider it in numerator. Guys, you understood or not? Tell me, you understood or not? Tell me. Okay. Issued 9% debentures with redemption right at a premium of 10% after 5 years. 750. Okay. Preliminary expenses written off from security premium 1 lakh. Okay. Outstanding equity shares during the year 1 lakh numbers. Tax expense 150. So this question is entirely based on the numerator part, since you have been given the denominator of 1 lakh already. The tax expense is also given. Okay. What you need to calculate? You need to calculate the earnings attributable to shareholders of parent company. So I am giving you 2-3 minutes just to calculate the earnings on rough basis on calculator. Please try to calculate it and I will discuss it further. Okay, guys, you must have tried the question. Let me now discuss it one by one. Let me now discuss it one by one. First of all, our EBIT is 35 lakh. Our EBIT is 35 lakh. Now, first of all, we'll deduct the interest cost, the interest on 8% debentures. If you will calculate interest on 8% debentures of 1 crore 20 lakh, you will get 9 lakh 60,000. Here, one more interest on debentures will be calculated, 9% debentures, but these 9% debentures are to be redeemed after 5 years at 10% premium. So the 9% is not actually the effective rate. If you are going to redeem this, after 5 years, you have to pay the extra premium. So the extra premium is also your expense. You have to calculate the effective rate of interest. Remember, Ind AS 23 borrowing cost. We always calculate borrowing cost considering effective rate of interest. So for this 9% debenture, we need to calculate effective rate of interest. In our answer, the effective rate of interest has already been calculated, 10.63. But definitely, I will definitely calculate how to. I will definitely calculate how this 10.63 arrived. But after some period of time, after discussing the entire question, I will calculate how this arrives. So 10.63 is the effective rate of interest on 7,50,000. 10.63, 750 into 10.63. So it is like 79725. So it becomes EBIT minus this. So now 2460,275. It is EBT, and after EBT, there are some more things like 9% cumulative preference shares 8 lakh, dividend not declared. Non-cumulative preference shares 10 lakh, dividend declared. Out of about 9% cumulative, 25% redeemed in the beginning of the year at 3 lakh. So 1 lakh is the premium. So first of all, premium on redemption of preference shares, 1 lakh. Preliminary expenses, write off from security premium, 1 lakh minus preliminary expenses not charged to P&L, 1 lakh minus tax expense, 150. Tax expense of 150 is there. Okay. Earning after tax, 1 lakh, 150. It's 2110,275 minus dividend on preference shares. Dividend on preference share, there are two preference share with us. Is with us, cumulative and non-cumulative. As far as cumulative is concerned, we have 8 lakh, but we have redeemed 25% in the beginning. So we have 6 lakh outstanding. So 6 lakh into 9%. 6 lakh into 9%. Cumulative 54,000. 6 lakh into 9%. How this 6 lakh arrive? 6 lakh arrive after reducing 25% the redeemed portion in the beginning. Now 9% cumulative preference shares, okay, non-cumulative. They were issued on 1st of June 18, 1st of June. That means after April and May. So the proportionate dividend will be non-cumulative. 10 lakh into 10% into 10 by 12. It's 10% now? Yes. That means June to March. It's 83333. It's 1972942. It is earning attributable to equity shareholder, EAESH. Guys, look into this. Which one was difficult? If you want to ask anything regarding these figures, if you want me to explain it again, any kind of figure, you can ask me. Now, sir, how this 10.63 arrive? How this 10.63 arrive? Effective rate of interest. Acha, first of all, let me complete. Divided by 1 lakh numbers. So divided by 1 lakh. The EPS could be 19.729 per share. 19.729 per share. Okay. Okay, now what is the working of this 10.63? Simple. Issued 9% debentures with redemption right at premium of 10% after 5 years, 750. 750. So cash outflows, future cash outflows, first year, second year, third year, fourth year, fifth year. So 750 into 9%, 67,500, 67,500, 67,500, 67,500, 67,500 plus premium of 10%. So 750 plus 10% redemption, 825. The redemption value, 825. Now I need a rate at which the present value of sum of present value of all these figures should be equal to initial inflow of 7 lakh, क्या था यार, 750 of 7 lakh 50. So if you will calculate the IRR, you will get this 10.63. You will get this 10.63. So a rate at which the present sum of present value of all these figures should be equal to 750. It's 10.63. You have to calculate by trial and error method, like you have to assume two different rates, and by interpolation technique you will get approximately this one, this answer, 10.63. Please tell me. Please tell me. Have you understood this thing? This was illustration number 5. This was illustration number 5. Okay. This was illustration number 5. Illustration number 4 over. Illustration number 5 done. For the exam purpose, you can tick. You can mark it for exam purpose. Got that? Okay. Now, what about denominator? I am giving you homework to read this question. Read these 3 points. I am giving you just homework to read these points, and also read this also. Deciding the date of issue of shares. Okay. So this is your homework part. Please don't go anywhere. I want to talk to you after this live session will become over. I want to talk to you regarding our schedule. Please don't go anywhere. So denominator part, you have to read it. Denominator part, you have to read it. Deciding the date of the issue, you have to read it. Deciding the date of issue, you have to read it. Hi guys, good morning to all of you. So how are you? How are you all? I hope you all must be fine. Good morning Sharat, Arya, good morning. Okay, so we were talking about Indas 33 earnings per share, right? In the last session we started Indas 33 earnings per share. Earnings per share. Okay. I have given you some homework to read, like denominator for basic EPS, you guys has to read. Deciding the date for issue of shares, you guys have to read this thing. So, good morning Rashmi, good morning Anila. Good morning Pooja, good morning Mohammad Nawaz, good morning Akash. So what about the homework? Have you guys read that? Have you guys read that points? Tell me. Good morning Binu. Yes, Rashmi, yes. Okay. Sharad, Sudarshan Arya, Akash, yes, yes, yes. Okay. Okay. Okay, let's continue with the same. So guys, let's continue with the same. Okay? For the purpose of calculating basic earning per share, the number of ordinary shares shall be the weighted average number of ordinary shares outstanding during the period. So basically for the purpose of denominator, we need weighted average number of ordinary. Here ordinary means equity capital. The weighted average number of ordinary shares during the period is the number of ordinary shares outstanding at the beginning of the period, adjusted by the number of ordinary shares bought back or issued during the period, multiplied by time weighing factor. Now what is this multiplied by time weighing factor? Let us take an example. Let us take an example. Please write this example first of all. Equity shares outstanding in beginning of year 1 lakh 1st April, 1st of August public issue 60,000 numbers. 1st of December buyback 12,000 numbers. Right. So during the year there were some of the transactions relating to ordinary share capital, equity share capital. Right. Now how to calculate the weighted average ordinary shares or weighted average equity capital? First of all, like on 1st April, we have 1 lakh numbers. We can say that since these are outstanding since beginning, so these were outstanding for the entire year. So multiplied by 12, divide by 12. So what is this multiplied by 12 and divide by 12? It is a time weighing factor. See, 12 are the total months in a year, and these shares were outstanding for the entire year since beginning. 1st of August, we issued 60 numbers. We issued 60 numbers, right? We issued 60 numbers, right? Now, we issued 60 numbers on 1st August. That means these shares were not at all outstanding on April, May, June, July. These shares were outstanding since 1st August. So, August, September, October, November, December, January, February, March. So, these were outstanding for 8 months in a year. 8 months in a year. So, 40,000. Then 1st December. 12,000 shares were bought back. Now, what do you mean by buyback? Buyback will reduce the equity capital. Buyback will reduce the equity capital. So, 12,000 shares were bought back. And they were bought back on 1st of December. Now, try to understand that these shares must be the part of opening equity. These shares must be the part of opening equity. That means these shares, the shares which are bought back must be the part of this opening 1 lakh shares. That means out of 1 lakh shares, we bought back 12,000. Okay, we bought back 12,000 equity. Now, in those 1 lakh, we assumed that these all 1 lakh are outstanding for entire 12 months. But this is not the right case, because out of 1 lakh, 12,000 were outstanding only from April to November. Because on December 1st, we bought back. So, December, January, February, March, for the 4 months, these 12,000 shares were not outstanding. So, into 4 divided by 12, it will be 4,000 and it will be deducted. It will be reduced. Why I am reducing? Because these 12,000s, this 12,000 figure is already included in 1 lakh, and on these 12,000, we have already made 12 by 12 calculation. That means on this 12,000, we already assumed that these were outstanding for April to March. But this is not the right case. They were outstanding from April to November. So, I need to deduct for the rest of the 4 month part. So, December, January, February, March, for the rest of the 4 month part, we reduce the weighted average working. So, finally, we got 136. So, 136 is weighted average outstanding equity. Weighted average outstanding equity, 1,36,000. 1,36,000. Weighted average outstanding equity. Tell me. Guys, understood or not? Is it clear? Is it clear? I would like to take name of some of the students who are not actually active during the class, during the session. Sometimes I feel that they are not active. Rashmi, I personally feel that you are not active properly in the live session. Sharad, you are not active, although you have made the comment, but okay, you are not regularly active in the live sessions. So it's a kind request, whenever you join, it's a kind request to all of you that whenever you join the session live class, please be active during the entire session. Okay, now the same example could have been solved by some other way also, by some other alternative also. Now, see how can we solve this. Alternative number 2. Alternative number 2. Alternative number 2. Now the same example could be solved with some other alternative. How? Equity shares outstanding in the beginning of the year 1 lakh. So these were outstanding 1 lakh since beginning. So we can say that in the month of April there were 1 lakh shares. In the month of May 1 lakh shares. April, May, June. In the month of June 1 lakh shares. In the month of July 1 lakh shares. In the month of July 1 lakh shares. Guys, understood or not? April, May, June, July, there were 1 lakh shares. And in the month of August, we issued new shares. So basically, 1 lakh shares were outstanding for 4 months. Cumulatively, 1 lakh shares were outstanding for 4 months. April, May, June, July. So this will be 33,333. After July, in the month of August, new public issue was made, 60,000. So 1 lakh plus 60, it becomes 160. Now 1,60,000 were outstanding from August onwards. So in the month of August, it was 160. September 160. October 160, November 160. So 160 were outstanding for 4 months. So 160 into 4 divided by 12. This is 53,333. And after 160, we bought back 12,000. We bought back 12,000. So it becomes 148. And 148 shares were outstanding with effect from December, January, February, March for 4 months. Guys, it is a cumulative approach. It is a cumulative approach. $1,36,000. The answer is same. It is cumulative approach. And what was it? It was an individual approach. Individual approach. So under individual approach, we individually make weighted average for each and every transaction. Here we are making weighted average cumulatively. So is this understood to you? Is this understood to you? Is this understood to you? Tell me. Okay, clear? Clear? Next, the time weighing factor is the number of days that the shares are outstanding as a proportion of the total number of days in the period. Total number of days in the period are 365 days. We took 12 months we took in the form of months. They are saying in the form of days. See, obviously when you take days, it will be the more accurate answer. You will get more accurate answer. A reasonable approximation of the weighted average is adequate in many circumstances. Okay, let's try to solve this question. I'll discuss with you this question. Now see this. Following is the data for company XYZ in respect of number of equity shares during the financial year 11-12. Find out the number of shares for the purpose of calculation of basic earning per share as per India 33. 1st April 2011, opening balance of outstanding equity, that means 1 lakh. Okay, 15 June. Now see, the dates are odd. 15, 8, 22. Since the dates are odd, you can't take months. You have to take the number of days. You have to take the number of days, guys. So for opening, we took 365 divided by 365. For 15 June, issue of equity shares, 15 June. So 30 June minus 14, 16 July, August, September, October, November, December, January, February, March, 290 days. Yes, 290 days. So it is 290. Then 8 November, conversion of convertible preference shares into equity. Yes, they will become the equity from 8 November. So from 8 November, they are treated as equity shares. So 8 November, 30 minus 7. So November, December, January, February, March. 144. 144. So it is 144 days. 144 days. Buyback, 22 February. Buyback. It should be 38 days, but it should be minus, deducted, 38. 38 to be deducted. So guys, please try to calculate with this working. Please try to calculate with this working, or see the solution also. You can see the solution also. Please see this and then please let me know if you have any doubt. Okay, so this was a very easy question. I don't think that anybody should have any kind of doubt on this. Done, Akash, Arya, Sharad, Rashmi, Nawaz, Anila. Okay, done. Deciding the date for issue of shares. See, just like buyback, public issue, there can be some more circumstances, there can be some more transactions in respect of equity. Like public issue is a common, very common. Buyback is very common. But there are some more transactions in respect of equity as far as weighted average rate is concerned. Shares are usually included in the weighted average number of shares from the date of consideration is receivable. From the date the consideration is receivable. Like the point is, from which date we should take weighted average? The date from which consideration is receivable. This is the general rule. Like in case of public issue. In case of public issue, the date when consideration is receivable will be considered as the date for weighted average. Now, for the aforementioned provisions are summarized. Now, for these kind of different transactions, the date can be taken like this. The general rule is consideration is receivable. Exchange for cash. Now, if you issue the shares, if you issue the shares and you are going to receive the cash, so when the cash is receivable, this will be the date. The date when the cash is receivable, it is due. It will be the date from which you can start taking weighted average. Voluntary reinvestment of dividend. Sometimes there's a situation where you opt one particular thing, like you don't want any kind of dividend from the company. The same dividend will be reinvested in the form of shares. That means the same dividend will be reinvested and you will get the extra shares. So the date when the dividend will be reinvested, reinvested, you will take the new shares. So the date of reinvestment. So these are the different issues. Now here, in case of business combination, like in the business combination means acquisitions. When one company takes over the business of another company and issues its own shares to the shareholders of another company. When it issues the shares, so basically it is the date of acquisition of control. When we got control over other company, that date will be taken for the purpose of weighted average under business combination. Mandatory convertible instruments. Now, as far as mandatory convertible instruments, we have separate paragraph for this. This one. We have separate paragraph for this. So, we will definitely discuss it in detail. But what is written? From the date of contract. Which contract? We will discuss it later on. Contingently issuable shares. Contingently issuable shares. When all the necessary conditions are for conversion are satisfied. Now, what is this contingently? Again, for this contingently issuable shares, we have the separate paragraph. If I am not wrong, we have the separate paragraph for this. Let me check 1 second. Contingently issuable shares. Okay. Like contingently issuable shares are the shares basically which are issued based on some fulfillment of conditions. The condition may be uncertain. Like I will give you shares only when the performance will be more than 50%. Then only I will give you the shares. So they are based on some conditions, uncertain conditions. When all necessary conditions for the conversion are satisfied, this will be the date when you will take the weighted average. And there are so many cases, like you can read it all, right? Okay. Now next one, ordinary shares issued as a part of consideration transferred in a business combination are included in the weighted average number of shares from the acquisition date. from acquisition date. This is because the acquirer incorporates into its statement of profit and loss the acquiree's profit and loss from that date. This is because the acquirer incorporates into its statement of profit and loss the acquiree's profit and loss from that date. Obviously, under business combination, under amalgamation, the date of acquisition is very relevant. The date when we actually acquire the control over acquiree is very important, because from that date only we take all the assets, we take all the liabilities, we take all the earnings from acquiree. Even from that date, the consolidation starts. From that date only, we start consolidating the profit and loss of acquiree. So technically, that is the date from which on which we can take weighted average. Okay. Contingently issuable shares are treated as outstanding and are included in the calculation of basic earning per share only from the date when all necessary conditions are satisfied. See, when sometimes the company issues shares based on some fulfillment of conditions. Now, if the condition will be satisfied, shares will be issued. If it is not satisfied, share will not be issued. So, as soon as the date when conditions are satisfied, that condition will be taken for the purpose of weighted average working. Shares are issuable solely for the passage of time, are not contingently issuable shares, because the passage of time is a certainty. Now, can you guys explain, or okay, let me explain only. Shares that are issuable solely for the passage of time. Like I told you that suppose I took over your business, or no, not the business. Let's forget. Suppose I purchased one asset. Right? I purchased one asset from you for a consideration of 5 crore. Out of 5 crore, I have given you 1 crore rupees in cash. So this is not the share. As far as remaining 4 crore are concerned, I issued 3 crore rupees of shares immediately, and the rest 1 crore, I will issue rest 1 crore after 1 year. I will issue 1 crore, rest 1 crore after 1 year. So this 1 crore can be treated as contingently issuable share? No. These 1 crore will definitely be issued after 1 year. There is no contingency involved here. It is just like I am issuing the shares after 1 year. It is just a passage of time. Here, any kind of uncertainty is not involved. Understood or not? So these 1 crore will not be treated as contingently issuable shares. So sir, what about the weighted average? From which date we can take weighted average? Obviously after 1 year. Understood or not? Do you guys understood this thing? So shares that are solely issuable solely for after the passage of time are not contingently issuable shares. Tell me guys, have you understood it? Outstanding ordinary shares that are contingently returnable, that is subject to recall, are not treated as outstanding and are excluded from the calculation of basic earning per share until the date the shares are no longer subject to recall. Subject to recall means here basically like what we can say, put option. If you can understand, put option. Now what is this put option? Put option or subject to recall or the company has issued the share, but the company has the option to recall it, right? Company has the option to buy back. So till the time there's a buyback option or there's a recall option, you can't consider it as a part of normal ordinary equity share. Understood or not? So call option, put option is with the entity, not the put option exactly, because it is with the company, it is with the shareholder only. Suppose the company is having call option, so company may call the shares issued, anytime, whenever it wants. So basically they are not treated as ordinary equity shares. Understood? They will not be treated as ordinary equity shares. Guys, please read example number 1 and example number 2. You need to read the example number 1 and example number 2, and if you have already read, then please read it again and then we'll continue further. Okay, there is one doubt asked by Mohammad Nawaz. Sir, can you explain difference between put and call option? Obviously, bilkul. What is put option? What is call option? What is put option? What is call option? See, put option means shareholder has right. Yeah, simply put option means right to sell. Call option means right to purchase or right to buy. Put option means right to sell. Suppose if I have given put option to my shareholder means the person who is holding my share, my company share. And if I'm giving him Muhammad, suppose if I'm giving you one put option, you are holding my company share. You are holding my company's share. Now, if I have given you put option, that means I am giving you right. I am giving you one right to sell the share. To sell the share back to me. That means I will be ready to purchase it at 35 rupees each. At 35 rupees each. Now definitely you will avail this option. You will exercise this option only when the market price of the share is lower than 35. When the market price of the share is lower than 35. See, in the market the price is 25 rupees. And I have given you the option. That if you want, you can sell your share. You can sell the share which you are holding back to me. I am ready to purchase at 35. This is called put option. This is called put option. It is right to sell. Anybody who has the option has the right. Now put means to sell. Call means to buy. Call to buy. Put to sell. Mohammed, are you understanding? Are you getting my point? Call option. What do you mean by call option? Now, what do you mean by call option? The call option means right to buy. Right to buy at 35. Right to buy at 35. Now suppose Mohammed, you are not my shareholder. You are not my current shareholder. You are not my current shareholder. Okay, now I have given you the option that if you want, you can buy the share at 35 from me. You can buy the share at 35 rupees from directly from my company. Now when you will avail this, when you avail this option, obviously when the market price is much more than 35, when the market price is more than 35, then you may have the option to purchase the share directly from Jaii sir. So basically, now instead of share, can we take the example of mobile phone? Suppose it is a mobile phone and it cost something around 60,000. It cost something around 60,000, right? It cost something around 60,000 in the market. Now Mohammed, I have given you the option to purchase the same phone at 50,000 from me. At 50,000. Obviously, you will avail this option. You will purchase the option because the market price is higher. But suppose if the market price is lower than 50, why you will avail the option? So this is right to buy. Understood or not? This is right to buy. Right to buy, right to sell. So I have given you the put option to sell the same asset, to sell your asset at particular price. I have given you the option, call option, to purchase a particular asset at a specified price. I hope you must have understood the put option and the call option. As far as this put option and call option, we will discuss the same in this Ind AS 33 as well as in financial instrument. In the financial instrument, Ind AS 109 in detail. And this put option, call option must be in your derivative chapter of SFM. Must be in your derivative chapter of SFM. Please let me know. All students, please let me know. Have you guys covered that derivative chapter of your SFM? I'm just asking about others also. Okay. So example number 1 and example number 2. It was very simple example. Like example number 1 was based on contingently issuable shares. Only if you achieve the profitability of 15%, I will give you the shares. Now in the first year they achieved 13%. I will not give you the shares. The condition is not satisfied. In the second year, 17% profitability was achieved. The condition is satisfied. As soon as the condition is satisfied, now I will consider the number of shares, the number of contingently issuable shares from the date the condition is satisfied, even though the shares are not actually issued. But in the second example, the shares will be issued only after 3 years. No other condition is there other than passage of time. So these are not contingently issuable shares. Understood? No, sir. No, sir means I think you haven't yet started your derivative chapter, if I'm not wrong. You haven't started your derivative chapter in your SFM, right? So in SFM, definitely you will read in future. You will understand about put option and call option. Okay. Okay. Haven't started. Okay. Partly paid shares. Partly paid shares. Partly paid shares. Partly paid equity shares are treated as a fraction of an equity share to the extent that they are entitled to participate in dividend. They are entitled to participate in dividend. Now, what do you mean by partly paid shares? How to deal with the partly paid shares? Okay, let me give you one example. Okay, what about partly paid shares? Like in case of while calculating weighted average outstanding shares, how to deal with the partly paid shares? And suppose if the partly paid shares are also entitled for the earnings, then how to deal with that? Okay. Let me check this illustration. Okay, wait for a while. Okay, let's discuss illustration number 7. Let's discuss illustration number 7. Calculate basic earning per share for 10-11. 10-11 is the financial year. Earning attributable to equity shareholders 10 lakh. Equity share opening balance 1 4 10, 16,500 shares of 10 each, 7 paid up. Now see, 1 4 10, it's 16,500 shares. It's 16,500 shares. Now these are partly paid shares, my dear. These are partly paid shares with 7 rupees paid up. Now please concentrate on the working. And please try not to write each and every thing. I'll give you separate time to write this, write the solution. So please concentrate. 16,500 is number of shares, but since it is a partly paid, so I will multiply it by 7. When I will multiply it by 7 rupee, it becomes equity share capital in rupees. 16,500 was the numbers. When I multiplied it by 7, it becomes share capital in rupees. Share capital in amount. It is amount of share capital. So, and it was outstanding on since beginning. So, into 12 by 12. So, 16,500 into 7 into 12 by 12. So, it is 115500. 115500. Now, public issue on 17 public issue, 10,000 shares of 10 each, 6 paid up. So we issued 10,000 shares, but again these shares are partly paid, so we multiplied it by 6 rupees because 6 is paid up, so it becomes a amount of capital into, it was, wait a minute, $10,000 shares were partly paid and they were issued on 1st July. So when they were issued, they were partly paid. So what to do? Into 9 by 12. Into 9 by 12. 45,000. 45,000. 45,000. Guys, please try to understand, this is not the weighted average numbers. This is weighted average amount of share capital. That means instead of calculating weighted average numbers, we are calculating weighted average amount of capital. Weighted average amount of capital. Okay. Received calls on 1st October, 16,400 rupees 3 per share. Now 16,400, the same opening shares. These were 7 rupee paid up. Now we received the call of rupees 3, but on 16,400 only. So on 1st October, 16,400, we received a call of rupees 3 rupees multiplied by 6 by 12. $24,600. Received calls on 1st November, 10,000 rupees 4 per share. 10,000 shares, remaining 4 rupees were unpaid. Now it is received into 5 by 12. It is 16667. So the total becomes 201,767. 201,767. 201,767. 201,767. Earning attributable for equity shareholders 10 lakh. So basic earning per share is 10 lakh divided by 201,767. It is 4.956. And what is it? It is basic earning per rupee. Per rupee. Now we call it basic earning per rupee. Why rupee? Because the 10 lakh is the earning and 201,767 is not the number of equity shares, it is the amount of equity share capital. It is weighted average amount of capital. So it becomes 4.956 per rupee. So what will be the basic earning per share? What will be the basic earning per share? 4.956 into 10. 4.956 into 10. 10 is the face value or 10 is the fully paid value. So it becomes 49.56. It becomes 49.56. It becomes 49.56. Understood or not? This is in case of partly paid shares. This is in case of partly paid shares. Okay. Any doubt? Any doubt, guys? I want to give you actually one more example on this. Okay, let me give you one more example. Let me give you one more example. EAESH. EAESH is a numerator, earning attributable to equity shareholders, is 15 lakhs, right? 1/4 outstanding equity of 10,000, 10 each. One August, public issue, of 7,000 numbers of 15 each. Now the face values are different. Both are fully paid. Both are fully paid. Both are fully paid. Only the face values are different. Only the face values are different. Both are fully paid. What will you do? Tell me, what will you do? Do you want to calculate or you want me to solve? Tell me, do you want to calculate, do you want to try it or you want me to solve? Okay, let's try it out. Okay, let's try it out. I'm waiting. Okay, I can't give you more time. It's a very simple question, guys. I can't give you more time. One 10,000 into 10 into 12 by 12 1 lakh plus 7,000 into 15 into 8 by 12 70,000. What is this? 1,70,000 is weighted average outstanding share capital. Weighted average outstanding share capital. Again, we considered share capital instead of number of shares. Since the face values are different, we need a common base. Okay. So now, earning per rupee will be 15 lakh divided by 170. It's 8.82. It's 8.82. It's 8.82 per rupee, and earning per share will be 8.82 into 10, 8.82 into 15. There are two different earning per shares. 88.2, 132.3. $83.91. No, Binu, your answer seems incorrect. It's not 83.91. It is 88.20. Please see the answer. Please see the solution. I think Rashmi and Binu has got wrong answer. Their calculation must be incorrect. Their calculation must be incorrect. Nobody is responding. Other than Rashmi and Binu, nobody has responded. Sharad, Arya, Anila, Muhammad Nawaz, you guys should at least respond. Forget about the correct answer. At least respond on time. Like, it's not a regular course batch. It's not a regular course batch. It is a fast track batch. It is a crash batch. So we need to take care of our timing also. Like, I can't give you more time to think. Okay, not getting any response, leave it. Now the next point is bonus issue, share split and share consolidation. Bonus issue, share split and share consolidation. Bonus issue, share split and share consolidation. Hello, okay. bonus issue, share split, share consolidation. This is the important part. This is the important part. Remember your IPCC CA intermediate days. This is the topic. Like in our IPCC intermediate, AS20 was there. If you remember, AS20 was there. So we already understood the bonus part, share split. But okay, let's forget about that. We'll discuss it in detail right now. We'll discuss it in details. Okay. Bonus part, share split part, and share consolidation part. Bonus part, share split part, share consolidation part. Now let's take an example for share split. For share split. Suppose on 1st April 2021, we have 1 lakh number of shares, 100 each. We have 1 lakh number of shares of 100 each. Of 100 each. We have 1 lakh number of shares of 100 each. Okay. On 1st September 21, on 1st September 21, entity decided to convert above 100 each share into 10 each. Into 10 each. That is 1 lakh into 100 divided by 10. It must be 10 lakh numbers. It must be 10 lakh numbers. It must be 10 lakh numbers. Calculate weighted average number of shares for EPS. For EPS. What will be our weighted average number of shares for EPS? Guys, see, in this question, there is no public issue, there is no buyback, there is nothing, there is no transaction at all. There is no such transaction where we can say that we received some money, we raised some funds. It is not a transaction of raising any additional funds. Understood or not? It is just a share split. Like earlier, there were 1 lakh shares of 100 each. Now there are 10 lakh shares of 10 each. The share capital is still same. There is no impact. There is no actual impact on the amount of share capital. There is no actual impact on the amount of share capital. So what will be the solution? Weighted average numbers will be 10 lakh. This one, the new shares, 10 lakh into 12 by 12. Yes, and it's 10 lakh only. 10 lakh into 12 by 12, it's 10 lakh only. How? See, initially they were 1 lakh of 100 each. Now they are 10 lakh of 10 each. So we can assume that the 10 lakh shares were outstanding since beginning. We will assume that 10 lakh shares were outstanding since beginning. Understood or not? So in case of share split, the numbers have been changed, but no impact on share capital. Same in case of share consolidation, the numbers could be changed, but no impact on share capital. No impact on share capital. So the weighted average numbers will be 10 lakh numbers for entire year, for the purpose of calculation of basic earning per share. Guys, please write this point, and same treatment will be done for share consolidation. We were having 1 lakh number of shares outstanding of rupees 100 each. Of rupees 100 each. Right? Okay. On 1st September, entity decided to convert above 100 each share into 10 each. Above 100 each share into 10 each. That means basically there is no new transaction in this. We haven't raised any funds. We just split our 1 lakh shares of 100 each into 10 each. Like 1 share of 100 each has been split into 10 shares of 10 each. So there is no raising of funds. There is no buyback. The funds are not came to us. There is no inflow. There is no outflow. Nothing. Ultimate effect on share capital, same. Even before the split and after the split, ultimate effect on share capital, it's totally same. It's totally same, right? So, earlier there were 1 lakh number of shares with 100 each. But now, there are 10 lakh number of shares. 10 lakh. See this, how we calculate 10 lakh. 1 lakh into 100 divided by 10. Now, there are 10 lakh number of shares of 10 each. So, what will be the weighted average? How you will calculate weighted average? Guys, here we will assume that these 10 lakh shares were outstanding for the entire year since beginning. So, the weighted average number will be 10 lakh entirely for the entire month. Understood? For the entire month. Guys, understood or not? Guys, understood or not? Clear? 1 lakh numbers. 10 lakh numbers will be considered as outstanding for the entire year since beginning. So because there is no impact on amount of share capital. There is no impact on amount of share capital. Guys, understood or not? So have you understood this share split part? So under share split, we actually don't make separate weighted average working. The entire 10 lakh will be considered as weighted average since beginning. Tell me, have you understood the part? Have you understood the part? Okay. Now same will be done. Now this one for share split. Now the same treatment to be done for share consolidation. Share consolidation is just the reversal of share split. Share consolidation is just the reversal of share split. It is just the reversal of share split. Guys, understood or not? It is just the reversal of share split. Okay. Now what about the bonus? What about the bonus? Now please try to understand. If I tell you one thing, that you have a balance sheet, and under balance sheet there's a you know very well there's a shareholder fund. Under shareholder fund, we have equity capital of 10 lakh, like 10,000 or 1 lakh numbers. And the second is reserves. Second is reserves. As far as reserves are concerned, these are 8 lakhs. So we can say that our total equity is 18 lakh. Our total shareholder fund is 18 lakh. Guys, okay, is 18 lakh. Please give me 1 minute. Please give me 1 minute. Okay, so total shareholder fund is 18 lakh. Guys, okay. Now suppose entity announced buyback. Not buyback. entity announced bonus issue. Entity announced bonus issue in the ratio of let us say 1:2. In the ratio of 1:2. What is this 1:2? 1:2 matlab for every two existing shares, you will get new one share. If you have 2 shares, I will give you 1 bonus. If you have 4 shares, I will give you 2 bonus. If you have 10 shares, I will give you 5 bonus. For every 2, you will get 1. For every 2, you will get 1. Okay, so basically the bonus is 50,000 numbers. How come 50? It was a 1 lakh number. So bonus is 50,000 numbers. 50,000 numbers into 10. So the bonus will be 5 lakh. Bonus will be 5 lakh. Now we very well know, we should know this, the fact that the entry of bonus is reserves debit to share capital. Reserves debit to share capital 5 lakh. Reserves debit to share capital 5 lakh. If I include this transaction in my balance sheet, so technically instead of 10 lakh there will be 15 lakhs. Instead of 8 lakhs there will be 3 lakhs. There will be 3 lakhs. Understood or not? There will be 3 lakhs. Guys, understood or not? But the overall effect on shareholder fund will be the same. The overall effect on shareholder fund will be same. So I just want to tell you that as far as bonus share is concerned, there is no impact on your ultimate equity funds. There is no impact on your ultimate equity funds or ultimate shareholder fund. Please first of all read this fact or write this, then we'll discuss further. Okay, so basically, if you consider bonus issue, if you consider share split, if you consider share consolidation, ultimately the effect on our total equity funds is nothing. The total equity funds remain same even after bonus shares, share split and share consolidation. So moral of the story is, as far as bonus is concerned, just like split, when we take weighted average, when we calculate the weighted average number of equity shares, we take the bonus numbers since beginning. That means, as far as bonus shares are concerned, like entity announced bonus shares on 1st of October, and this is outstanding since 1st April. So if I calculate weighted average number, for weighted average 1 lakh, 1st April 1 lakh into 12 by 12, even 1st October 50,000 bonus, I will take 12 by 12 only. I will take 12 by 12 only. So ultimately it will be 150. So as far as bonus issue are concerned, you have to consider bonus since beginning of the year. You have to consider bonus since beginning of the year. Guys, understood or not? You have to consider the bonus since beginning of the year. How beginning of the year, sir? We issued the bonus on 1st October, na? Dear, you issued the bonus on 1st October, okay, but you issued the bonus out of the existing reserves. So, we can say that the bonus capital is issued, like the 50,000 numbers was earlier in the form of reserves, now in the form of share capital. Basically, earlier they were reserves, now this is capital. So, technically, they already become the part of capital, na? So, isliye, you have to consider bonus issue from beginning of the year. Guys, understood or not? Tell me, have you understood this? So as far as bonus issue is concerned, we always do 12 by 12 calculation. Is it clear or not? Is it clear or not? Okay. Ordinary shares may be issued or the number of ordinary shares outstanding may be reduced without the corresponding change in resources. A capitalization or bonus issue, a bonus element in any other issue, for example, right issue, share split and reverse of share split. Guys, as far as right issue is concerned, I will discuss it in the next class, after the break, that means, okay. In the above case, where the number of shares changes without the change in resources, the date will be considered from the beginning of the earliest period presented. From the beginning of earliest period presented. Now, what is this? What is the relevance of this? What is the relevance of this? This is very much important point. This is very important point. In above cases, where the number of shares changes without the change in resources, without the change in ultimate capital, the date will be considered from the beginning of earliest period presented. Now, what do you mean by earliest period presented? Earliest period presented means from the beginning of previous year, from the beginning of corresponding previous year. Sir, from the beginning of corresponding previous year, why? You told us that from the beginning of the current year, and they are saying from the beginning of earliest presented period, matlab beginning of previous year. Why so? Irrespective of the fact that actual capitalization of the reserves. I am telling you one thing. I am giving you one example on this. Let us take an example. Let us take an example of bonus. My current year is 21-22. My current year is 21-22. Outstanding, first outstanding on 1/4/21. Outstanding equity numbers 1 lakh. Outstanding equity numbers 1 lakh. Not current year. Let us take financial year 2021. 2021. Outstanding, okay, 20. Okay. Outstanding equity numbers 1 lakh. Right. And earnings. Earnings was 10 lakh. So basically the EPS is 10. It's very simple. Okay, not an issue. The EPS is 10. Now in the next year, now financial year 21-22, in the next year, entity issued bonus of 1 lakh. Numbers 1:1. 1:1. Okay. Earnings are 20 lakhs. Earnings are 20 lakhs. earnings are 20 lakhs. Basically, what will be the EPS? What will be the basic EPS? The basic EPS will be 20 lakhs divided by 2 lakh. Sir, how come 2 lakh? Sir, how come 2 lakh? Sir, how come 2 lakh? 1 lakh was the outstanding shares original and 1 lakh is the bonus. So 2 lakh. So the basic EPS will be 10. The basic EPS will be 10 for the financial year 21-22. Okay, it's correct, not an issue. But the problem is when you prepare your statement of profit and loss, for 21-22, we used to show the figures of last year also. Like 21-22 is the current year and 20-21 is the previous year. This is the current year, this is the previous year. Forget about revenue from operation and all the expenses, all the incomes. Finally, when you show here your EPS, the EPS will be like 10 rupees and 10 rupees. But the earnings in absolute terms here are 20 lakhs and here are 10 lakhs. You got my point? See, here your earnings were 10 lakh. Here your earnings are 20 lakh. So earnings in absolute terms are 20 and 10. That means just double in the current year. But earning in the terms of numbers of share, that means earning in the form of EPS is same. It is same. Why so? What is the reason behind it? The reason is very simple, that in the current year we considered bonus. And we considered bonus as 12 by 12. Like we considered bonus since the beginning of the current year because it was a part of reserve. So India says that okay, it's a correct working, not an issue. We don't have any issue in this working. But when we consider the bonus in the current year, ultimately the EPS with the previous year is not comparable. Both the EPS are not comparable. Technically, earnings are doubled, but the EPS are same. So since it is not comparable, what we need to do? We need to revise the last year EPS again. We have to recalculate the last year EPS for the current year presentation. And how to revise? We consider bonus not since the beginning of current year, but since the beginning of previous year, earliest period presented. So now we will calculate a restated EPS of 2021 by 10 lakh rupees divided by 2 lakh numbers. How come 2 lakh? 1 lakh was the original number and 1 lakh is the bonus. We assume that the bonus was outstanding since the beginning of previous year, earliest period presented. So now our restated EPS is rupees 5. So here we will disclose not 10, we will disclose 5. Now it is definitely comparable. So what was the relevance of this point? The relevance of this point is, in case, now read this point once again. In case where the number of shares changes without the change in resources. Here the resources means total equity funds. The date will be considered from the beginning of earliest period presented. That means beginning of previous year, irrespective of the fact of actual capitalization of reserve. Yes, we do understand the actual bonus occurs in this year only, but you have to assume that the bonus was a part of last year also. Okay, this is the point. This is the example. Do you want to ask any doubt? Binu, it's clear, sir. Rashmi, clear, sir, no doubt. Pooja, clear. What about other students? They are not live? They are not live? Mohammad Nawaz, clear. Okay. Arya, Anila, clear, sir. If there is no change in the resources, the rate of change will not be relevant. And opening balance of the shares will be adjusted with a new number. See what is written. Opening balance of the share will be adjusted with a new number of shares. However, if the event is going to result in the change in total amount of capital, that is resources, then the effective date need to be considered, and accordingly the weighted average of shares need to be taken. Obviously, in case of change in ultimate shareholder fund, that means you have to consider the weighted average, effective date will be different. Okay. So in these three cases, bonus issue, share split and share consolidation, in these three cases, ultimately the ultimate effect on the equity or ultimate effect on shareholder fund never change. And this is the reason we consider the share split, share consolidation, bonus issue since beginning of previous year. Like in the same example, share split, as far as current year basic earning per share is concerned, we will take 10 lakh. Even for the previous year basic earning per share, we will calculate the restated basic earning per share with the 10 lakh rupees only. Okay. Guys, understood? Now I am giving you some examples. You need to solve it right now. You need to solve it right now. Okay. This is the example number 1 on bonus issue. Please write this example and solve it. I will wait only for 2-3 minutes. I will wait only for 2-3 minutes. Okay, what is the answer? What is the answer? Tell me. Guys, have you done the question? 2.225 187,500. Okay, see the solution. See the solution. The weighted average is 183,750. The weighted average is 183,750. The weighted average is 183,750. 183,750. 183,750. 183,750. Sir, how come? See, opening shares 1 lakh, 12 by 12, 1 lakh. Public issue 30,000, 9 by 12, okay. Bonus. Now the bonus is 1:2. Okay, we got that point. Bonus is 1:2. Now the bonus will be available on the opening as well as on the public issue. On the opening as well as on the public issue. So as far as bonus on opening, 1 lakh 1 by 2 because it is 1:2. 50,000 12 by 12 because the opening shares were outstanding since 1 April. But as far as public issue is concerned, yes, bonus on public issue will be available, but the bonus will be available, the weighted average will be for 9 months only. Why? Because the original public issue was issued on 1st of July. So the bonus on those shares will be taken from 1st July. Bonus on those shares will be taken on 1st July. Now, the bonus part on public issue portion will be taken from the date of public issue. Simple. From the date of public issue. And hence, we take 9 by 12, same as 9 by 12 as far as public issue is concerned. Like you can't do na, for public issue you are taking 9 by 12 and for bonus on public issue you are taking 12 by 12. How come? It is not possible. It is not possible. And this is the reason why we take 9 by 12 for bonus as far as bonus in respect of public issue. Total 183,750. Guys, tell me, have you understood this? Have you understood this? Tell me. So bonus part on opening shares 12 by 12. Bonus part on public issue, obviously from the date of public issue only. From the date of public issue only, obviously. Guys, understood or not? Like, as far as public issue is concerned, originally you took 9 by 12 weight. But bonus issue on public issue part cannot be 12 by 12. Cannot be 12 by 12. Guys, understood or not? So this was example number 1. This was example number 1. Do you understood? Okay, Sherry. Now, next example. Next example. Example number 2. Next example. Example number 2. Okay, there is one question from Binu regarding this question, right? And the question was as expected. Yes, the question is totally fair question. The question is, Binu asked, yes, the question is, sir, what if in this question, what if is this question have previous year comparison like last question? Okay, yes, okay, not an issue. That means Binu is asking that, sir, what about the last year working? What about the last restated EPS, sir? What about that? How will you consider? We'll, as far as last year concerned, we'll consider only 50,000 bonus, not this one, because this one is in respect of the current year public issue. The current year public issue was not there. The current year public issue was not there. So as far as last year working is concerned, I will take only this much from the beginning of earliest period presented. Understood or not? So as far as last year working is concerned, I will take this 50,000 only. I will ignore 11250. I will ignore 11250 because 11250 is on the original public issue which was done in the current year only. Understood, right? Tell me guys, understood? Okay. Sir, what about the example number 2? What about example number 2? Are you guys solving example number 2 or not? Are you solving example number 2 or not? First April 22, outstanding equity shares 1 lakh, public issue 40,000 on 110. Next year 23-24, public issue on 1/7/23, 15,000, bonus issue 1/4/23 and previous 22 for the purpose of restated EPS. Now solve it. Okay, solve it. Okay, so first of all, this is the current year working. This is the current year working. What was the question? In 1/4/22, in 1/4/22, 1 lakh was the numbers, public issue, 1 lakh was the outstanding, public issue on 1/10/40. In the next year, 23/24, public issue on 1/7, 15,000, bonus issue 1:4 on 1/9/23. So as far as current year working is concerned, you have opening is, your opening is 140 because last year there were 140 shares overall. Public issue of 15,000, okay, on 1st July. Now the bonus part, is calculated here under bonus part on opening 12/12, bonus part on current year public issue of 15,000, 9/12. So it is 189,062. Any doubt on current year portion? Any doubt on current year portion? Any doubt on current year portion? Tell me. Any doubt on current year portion? Any doubt on current year portion? Current year working? Any doubt on current year working? Okay. Now as far as previous year is concerned, we are calculating restated EPS, restated EPS. Considering bonus, restated EPS, considering bonus. So in the previous year, yes, there was 1 lakh beginning, okay, so 1 lakh 12/12, 1 lakh 12/12, okay. There was public issue of 110, 40,000, okay, so 40,000 6/12, okay, it becomes 120, guys. 120 was the original weighted average, but here we are talking about restated, guys, restated, okay. Yes, this 120 was original weighted average for the previous year, but now, one second, yes, now as far as bonus is concerned, bonus will be given on this 1 lakh, bonus will be given on this 40. As far as this current year public issue of 15, we will ignore this because this 15,000 was not there in the earlier year. This 15,000 was not available in the last year. What was available in the last year? Only 1 lakh and 40,000 was available in the last year. So the bonus will be calculated, bonus will be considered on the last year portion. So 1 lakh 1/4 12/12 because it was on the opening. 40,000 1/4 6/12. Why 6/12? Because the public issue was 6/12. So the bonus part on public issue will be same 6/12. Sir, what about this public issue 15,000? We will not consider the public issue of current year in the last year bonus. How can we include the bonus part in the last year? Because the public issue was done in the current year only. So bonus on the opening 1 lakh, bonus on last year public issue 40,000, but last year public issue was made on 1st of October, so the bonus portion will be included from 1st October only. Guys, understood or not? Bonus on current year public issue of 15,000 shall not be considered in the last year, because in the last year there was not a public issue of 15,000. Please write this first of all. Tell me guys. Interesting na? The bonus part is very interesting. How do you see this topic, Ind AS 33? Till now, how do you see this topic, Ind AS 33? Is it interesting or not? Binu, Rashmi, Pooja, Sharad, Mohammad Nawaz. Arya, interesting. Okay. Okay, this will be your homework. This will be your homework, right? Interesting and tricky. Interesting. Okay, we knew. Sharad. Illustration number 8 will be your homework. Illustration number 9 will be your homework, right? So these two questions are given as homework, illustration number 8 and illustration number 9, right? Illustration number 8 and 9. Sir, do we have class tomorrow? Yes, I'm going to discuss with you. Please, first of all, please concentrate on this. For tomorrow's session, I'm going to discuss about something. So as far as illustration number 8 is concerned and illustration number 9, you have the homework. Okay. Now it's time to take a break. Like, break means we'll continue tomorrow. Now today's lecture and tomorrow's lecture will be merged together, right? Now I'm taking break right now. Tomorrow, what about tomorrow? Since tomorrow is Sunday and result is coming, so I'll discuss with you, but please don't leave the session right now. Let me announce it as a break and then we'll discuss. Okay, so taking a short break. Thank you so much.